Thanks for clicking! The London and St. Thomas Association of Realtors has released London's real estate data for the month of February, showing plunging sales amid uncertainty to the south. And yeah, that uncertainty is definitely showing up in the sales data, with London sales coming in the second lowest for the past 12 Februaries. With that said, while we are seeing a dearth of sales, and we did see throughout February warnings about the mortgage renewal wave coming up this year, as we'll see today, there isn't much indication of that having much of an effect in London. At least not for February anyway. However, as we'll see today, the London market is very much shifting in the favor of the homebuyer, especially amid all of the uncertainty. And with it looking like these shifts could continue, I think it's worth going over how London buyers can protect themselves in a shifting real estate market.
Not smart. Not smart at all.
So what I want to do today is go over London's real estate data for the month of February, take a look at some of the shifts we are seeing in the London real estate market, and then go over why it's so important to make sure you protect yourself as this goes on. Speaking of how this goes on, the Bank of Canada is set to make its next interest rate announcement on March 12th with a press conference to be held thereafter, and we'll obviously have an update out on both on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, let's get into this data. Onto the data. First up, the benchmark price. The benchmark price, that's the price of a home that represents the most popular set of features, and that price was up in February. The benchmark in January came in at $617,300, and that was up about $5,000 last month, coming in at $622,100. So the benchmark is up about $5,000 since last month, and up about $35,000 since this point in time in 2024. And the average price behaved very similarly in February. The average price in January was $635,600, and that jumped about $6,000 to $641,490 in February. So very similar to the benchmark price, the average is up about $6,000 and up close to $40,000 since this point in time last year. With that said, the median price actually dropped. The median price, if you'll remember, that's where half as many homes sell over that price and half as many sell under. The median price in January was $590,000, and that dropped about $3,000 to $587,000 in February. So the median price is down by about $2,000 since last month, but still up about $2,000 since this point in time last year. And with the median price moving so little compared to that of the average, that indicates that we're probably seeing more of the higher end stuff selling, with more of the lower end stuff sitting on the market. Next, the sales to list price ratio, which measures by how much over or under asking a home sells. So if a home is listed for $100,000 and sells for $95,000, the SLPR would be 95.
Not on my watch.
And that was actually up in February. London's SLPR in January was 97.8, and that bumped up by 0.3 to 98.1 in February. So on average, homes are selling for about 98.1% of their asking price. And finally, the months of inventory measurement, the MOI, which measures if no more homes came to the market, how long would it take for London to completely run out of homes for sale. The MOI in January was 5.1 and is now sitting at 4.3. So we have the benchmark price up about $5,000, the average price up about $6,000, the median price down $3,000. Homes are selling for less under asking than they were, though still under asking, and the months of inventory tightened a bit, though still at a 14-year high. And while prices did rise, though marginally, it's not clear how long that is going to hold, as sales came in at 322, their second lowest number of sales that London has seen in February in the past 14 years.
I don't know what to do.
With that said, despite the concern over the mortgage renewal wave and the number of listings coming to the market that we saw throughout January, there wasn't a whole lot of evidence of that in London in February, with new listings coming in at 705, a tad higher than the 10-year average, but nothing really substantial to speak of. Though I suppose it's worth noting that these numbers could in fact be skewed, as it's really not that great of a time to be bringing your home to the market with so much inventory already sitting on it. So if sellers are going to be putting their homes up for sale at the same rate as they do when it is a good time to be selling their home, then these new listings could in fact be a sign of stress. Definitely something to keep an eye on. However, even though we're not seeing a whole lot of new listings come to the market, nothing abnormal for February anyway, because of the cumulative slowdown that we've seen over the past few months, the active listings, the number of listings available heading into the spring market, is at a 14-year high, coming in at 1,384, way, way higher than London has seen for the past 14 years. And while this means that Londoners have an awful lot of buying power, and that they can and should have finance conditions and home inspection conditions, and if the realtor can't make that happen, then they should drop that realtor and get one that knows what they're doing. And while all of that is true, in this environment, when inventory is this high and we are seeing some shifts caused by an exogenous factor, then we really want to talk about exactly why we have finance and home inspection conditions in the first place. Why it's so important to protect yourself in a shifting market. All things being equal, supply and demand, if this continues, if we continue to see the number of active listings stack up with a dearth of sales, then eventually we will see prices drop. Economics 101. We're all familiar with London's price crash that happened post-rate hikes in 2022, when the average price was sitting around $820,000, then fell to $564,000 within a year's time, and as of 3 years later, is now still $180,000 less than it was at its peak. But corrections can also happen steadily, where, as we saw back in the early 2000s, Canada's average price was heading up steadily, nothing major like we saw during the pandemic, but steady, and then an external event occurs and sends them down suddenly. We saw that post-global financial crisis. Given all of the uncertainty that's coming out of down south, it's not exactly out of the realm of possibility that London could see further price corrections, especially as inventory continues to stack up amid a weakening economy.
That's not possible.
And while we don't know if or when that price correction will happen, what we do know is that you don't want it to happen when you've waived conditions without having your financing secured 100%. Say you've agreed to buy a home for $500,000 and you're going to put down $100,000. The bank has agreed to finance 80% of the purchase price, but for whatever reason, ask that you get an appraisal on that home.
Let me talk to them.
Kid you not, I've seen it. But let's say the lender wants an appraisal and unbeknownst to you or your professional, the market has shifted and that appraisal only comes in at $450,000. The lender is still only going to finance up to 80% of the purchase price or the home value, whichever is lowest, so the lender's only going to give you $360,000. Meaning, to meet that $500,000 purchase price, you now have to come up with $140,000. And if that homebuyer can't come up with the difference, but has already waived the conditions and then can't close, that homebuyer can, and probably will, be sued for any losses incurred by the seller, as evidenced in Gamoff v. Hugh. Back in April 2017, Hugh had agreed to purchase a home for $2.25 million, subsequently backed out of that purchase, and then by the time the home eventually sold in the summer of 2017, the market had shifted. Only a few months later, and that home only sold for $1.8 million. Gamoff took Hugh to court for the difference, and the judge ruled in Gamoff's favor, ordering Hugh to pay the difference. And make no mistake, the realtor that's pushing you to waive your finance condition knows very well exactly what the laws are. I've seen it before where that condition got waived, and then the appraisal comes in lower than the purchase price, but lo and behold, the realtor has a guy from Toronto willing to lend at that higher loan to value, but the interest rate is around 9 or 10% plus fees.
I see nothing.
And you really, really, really want to avoid this, especially in a shifting market. Now, is a big price swing going to happen within a few weeks' time? I don't know. Back in 2017, as evidenced in the court case, a $400,000 price swing occurred within April to the summer. And the point is, there's so much inventory out there, there's so much available on the market, it costs you literally nothing to have a finance condition put in place, to have a home inspection put in place, giving you, say, 1 week's time to get all of your ducks in a row. So amid all of this uncertainty, if you are going to be in the real estate market, if you are looking for a home, with so much inventory sitting on the market and so much uncertainty in the economy, you definitely hold a lot of the cards. With all of that said, we will obviously continue to track how all of this plays out and of course its effect on the London real estate market on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, thanks so much for watching.